Hey, this is Asha. Thanks for joining me in today's video. And what I want to share with you today is dollar cost averaging and how to use it in investing and really the power behind it. So stay tuned. We're going to talk about that in this video. All right, so if you've been around the block a little bit, you might have heard dollar cost averaging in terms of investing. If you're brand new though, you might have not heard about it. Now there's always going to be some people that hate certain strategies and love certain strategies. And here, I just want to open up your mind to this strategy so you can see if it makes the most sense for you. So there's a lot of people that use this strategy successfully. They look at it in the long run because the whole point behind dollar cost averaging is knowing and understanding that the market and inflation just continues to rise over time. Houses a long time ago were a lot cheaper. You could have bought a house for $20,000, $50,000. Now those same houses are $200,000, $500,000, $1 million, depending on the location. So with time, things just continue to naturally inflate. And if you dollar cost average in the market, whether it's in the stock market or dollar cost average, even in a real estate market, with time, those things will appreciate. So this is how it looks, but before we get there, keep in mind that we have a lot of great freebies at MyLittleNestEgg.com, so go there, check out the Getting Started page and some of the freebies. And if you're interested in more on investing, check out my other YouTube channel, Traders Fly, there that you can see much more on investing topics. Okay, so let's check out this dollar cost averaging and what it really means. So if I look at dollar cost averaging here and we check this out, this is kind of a basic line of, let's say, price of a stock or price of anything like real estate over time. And I've put it in months. This could be years, depending on what you're doing. It could be in days. But over time, markets fluctuate. Prices of blueberries, strawberries fluctuate with time. And what your goal is to go ahead and purchase at certain points. And let's just say I do it every single month. So you go ahead and you do it every 2 months. I go ahead and put some money in. And with time, what you're looking to get is to be at a later date and time to be at a higher price than what you've bought things at. So this is what you're really doing is that sometimes like points like this are a little bit at higher points. And other times what's going to happen is you'll be at lower points like some of these points. So what you're trying to do is with time, as you look to these things, go ahead and create a nice average. So in the future, you're basically growing your investments without, some will be on the bottom area and some will be in the top, but over time, you'll still be kind of ahead. And that's what you're looking to do is that on down times, it's good to put in a little bit more money because eventually those investments will go up. And you can see this in the stock market world as you look to things like, let's say, the GoDaddy. Here's a monthly chart. You can see here we started, and if we put money in every month, right now we would be a lot higher. You could see this in Netflix. Like, look at this over the last 20 years or so, how prices continue to rise. And if you put money in time and time again, you would be ahead. Here's CSX, the same thing on a monthly basis. So what you can do is go ahead and do this. And here's Disney. Let's just say we take the last 10 years or so. And here I'm going to go ahead and do some quick calculations. This is Airtable. I'll go ahead and put a link here in the description for you guys. But let's say we go ahead and pop in some prices here at 2010. And we'll just do it for a few years just so you can see. So I'm going to go ahead and put those prices in and show you the result of what you would have made at the end. Okay, so here's what I did was I basically took kind of that January opening price on every single date when it comes to Disney stock. So I've taken it in 2012, 2013, 2014, 2015. So if you go ahead and buy $10,000 worth of Disney stock every single year at the beginning of the year, kind of like a Christmas present to yourself, here's the way that the investment would have panned out. And this is what I want to show you with dollar cost averaging. Is that when you look at this, is that there's some times that you have pullbacks, sometimes where things didn't make you as much money, and other times where things just continue to move up. So in our case, here's my kind of table and spreadsheet. So here is all the dates that I went ahead and put it in. I'll go ahead and link this up. This is Airtable, so I'll link it up for you if you want to get this software. And what you could do is go ahead and I put in the date right here. So here's all our dates. And I went ahead and tried to use about $10,000 for each transaction. So here is, In 2010, it was $28.56 per share. So I was able to get 325 shares. So that would have been, about $9,282. Yeah, I probably could have got 330 even, and maybe even a little bit more than that. So as you continue to go ahead and keep dollar cost averaging, so in 2011, you got maybe 225 shares, then 260 in the next one to 180. As the price kept heading higher at $52 a share, you were able to get less and less shares, right? Because by the time we're getting into recent prices, you were going in, you're doing the same amount, but you were able to get 330 shares a while back. Now you're only able to get 85 and 65 shares because the stock price is way higher. Now in total, the amount of shares is 1645. So if you go ahead and 1645, you have your total share count, and the current price is 108.90. So you can take a look at that right there. 108, well, let's say 70 now. It's moving around today. But let's say 108.70. Now, the total value of your account would be $178,000. Now, the amount of money that you put in was $105,000. You did it over 10 years, right? About $10,000 at a time. So when you're looking at this in 2010, 11, 12, 13, 14, 15, 16, 17, and 20, so that's basically 11 years, you've got $105,000 there invested, and your value, though, is at $178. So think of that. You put in 105 and you got out about 178. So you almost doubled your money in 10 years. Now, this is fantastic, great returns, but that doesn't even account for the dividends that you would have gotten 4 times a year from Disney stock. So think about that as well as that goes into play. This is just from the dollar cost averaging appreciation part as the stock price is wiggling around. Now you may think, hey, this works really well on the upside, but how well does it work on the downside? Well, let's take a look at maybe even stocks like Wynn that's been going down recently. Here is the last kind of 10 years as we look at this. Let's go into the monthly. And what you'll see is that by doing this over a 10-year period, if you want to do the exercise, you'll realize that this, by the time you do it, at least you might not be as profiting as much as maybe the Disney, because that one was an uptrend. But the thing is because you'll have some of this downward areas where you've bought stock at, and the stock price, as long as it's kind of at the break-even point, by getting it even just a little bit above some of those lows that you've purchased it at, it allows you to almost break even, because even though you might have caught some at the high end, you've also probably got some at the low end. So as long as that stock price is somewhere in the middle or in between levels, you could be okay. Let's look at maybe, let's see, another one, maybe, let's see, Roku. Like, let's take Roku, for example. Like, let's say you got into the stock right here, and you started dollar cost averaging at different points. Well, as long as that stock is kind of in that same area, because you've probably dollar cost averaged over here in this zone, and you've gotten a few under the price, and you've gotten some shares above the current price, that's really where it allows you to kind of save face, where your money and investments are not as bad as maybe just buying at a single point, because buying at a single point concentrates your risk at that specific price point. Whereas dollar cost averaging, it allows you to spread your risk across time at different price points. And now, as long as you've got a few that are at lower prices than where you were or where the current stock price is, then that's fantastic. That allows those, allows you to be profitable and things to continue to run up. So anyways, that's the basics behind it. That's the way that it works and functions. And I hope you learned quite a bit from it. And don't forget that you could go ahead and check out some of the freebies and getting started guides on our website as well. Anyways, thank you so much for joining me. Grab those freebies by clicking the link over here, or subscribe to the channel by clicking the link right here. Thanks again, and I will see you next time.